Welcome to AllGen Academy. So as we do financial planning with our clients, one of the biggest questions that come up is the purchase of a home, because it's usually the biggest purchase that we make in our lifetime. Okay, so unfortunately we've come across people who, especially right before real estate bubbles crash, burst, etc., we've noticed that decisions were made during these times that maybe weren't the best, because there was no real guidance on how should I buy a home.
Well, another common one too is when people are about to have a baby. They just have this emotional sense that they have to buy a home before they have a baby. So sometimes they just hop into a home that may not be right for them.
So we want to take a few minutes to explain some considerations, some factors, equip you with some tools to help you make a better decision when it comes to buying your home. So Jason, let's jump right into it. Here's some considerations, and again, before you actually buy a home, ideally, now people come to us at different stages, but ideally you have no more consumer debt, okay? You have enough emergency funds, okay, that isn't touched, okay, and you have enough for down payment in addition to the emergency funds, okay, because I've seen some people, I saved X amount, I can use it to buy my home. No, emergency funds should still stay in place even after you purchase your home.
Well, I can tell you, I learned this the wrong way, or the hard way. Whereas when I bought my first home, I had just got married. I had a lot of pressure from my parents and people around me. You don't own a home yet. You should own a home. You're just renting. You're throwing money away. And so I felt this, overwhelming. And by the way, that housing prices were going up a lot, and I felt like I was missing out. I had that FOMO, as they say. So we had to get into a house, and we got into a house at the absolute wrong time in like 2006, in the peak of the real estate bubble. We did it with a horrible mortgage. It was an interest-only ARM, which you should stay away from. And that house, and we had no emergency reserves.
Oh my goodness.
And we still had consumer debt. And so we got into that home. We really, and then naturally, when you buy a home, what happens? Oh, you got to get furniture. Oh, you got to fix like 3 or 4 things in the home. And then cha-ching, 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 much more money. So, starts going up. All that's going on, more credit card debt. So that home it wasn't a blessing. It became a curse. And literally, we sold that home 11 years after buying it, still underwater on that home, and lost money. The house actually went down in value over that 11-year period.
Wow.
And so we learned the hard way what not to do.
Right. And that's an important story, because this is real life, and you hear, oh, I only invest in real estate or this and that. Yeah. Mortgages real estate has its cycles as well. Historically, yes, long term it goes up, but it's got its ups and downs, 2008 being one of them, when we saw that. But there are benefits to buying a home, especially when you do it the right way.
Yeah, when you do it the right way, you have no consumer debt, you have emergency reserves, and then you have additional savings for your down payment, and you buy a home. Then the benefits once you buy the home is, especially if you get the right mortgage, which we're going to talk in a little bit, it's a forced savings plan. So you're putting money to that principal every month, and that principal is going down, which is building your equity. A lot of times too, it acts as an inflation hedge. So if there's inflation, a lot of times your house price is actually going up as well, similar to the rate of inflation.
Your mortgage, if you did the right one, should stay the same.
Or
your mortgage payment should stay the same.
Right, the payment,
And so, rents might go up. So if you don't own a home, you're subject to whatever that happens. But if you've locked in a good rate on a good mortgage, you've locked that in.
That's right.
For your budgeting purposes.
And like we said, that potentially the property can appreciate over time, and depending on which market you're in, sometimes it'll appreciate faster or not. But that's not a guarantee. Like I told you my story through 2008, it went down quite a bit.
Right. So here's some things to consider when you're buying a home, because most people, Jason, they may use a realtor, which is a good thing. Those are professionals, and they'll have to use a mortgage institution or broker to seek their approval. But here's some things to be looking out for.
Absolutely. So, the key thing here is you want to find a good location. Okay, everyone hears location, location, location. That's the most important thing when buying a home.
Right.
Along with that, even if you don't have kids that are going to school, try to find an area with good schools. Because if you ever go to try to resell that value, that home, that'll be a higher value if you have good schools. So another little trick is to try to find a home that's in the lower end of the price range for that neighborhood. Okay, let's just say you find a neighborhood, and on average the homes in that neighborhood are going for around $400,000. but you can find maybe a smaller home or an older home that just needs some, kind of some help with the lawn and cleaning things up and some TLC, but you can find that for $300,000. That is usually a better buy because over time that will be closer to the medium average of the homes in that neighborhood. Try not to buy a home on the higher end.
Most expensive house in the neighborhood.
You don't want to buy the most expensive home, or you don't want to overbuild or remodel and make that home so that you'll never get that value out of it if you try to sell it after you putting in that much money in that particular neighborhood.
Right.
So if you can't afford just a single family home, something that you could look into is like a townhome or a condominium. But when you do that, make sure you also budget for monthly maintenance fees, and also know that there is a chance those monthly maintenance fees could go up over time.
Like homeowners association fees that tend to be higher for
That's
those
right. That
types
too.
of buildings.
Yep. Or if you're handy, you could try to find a fixer-upper. I've personally done that quite a bit over time, but just be very cautious with major repairs. So when you go in and you buy the home, you get a home inspection. If there's major repairs, like if there's structural issues with the foundation, or you see a lot of cracks in the walls and the house is literally falling down, or it needs a lot of electrical or plumbing, or the roof is really old and you have to replace the roof as soon as you go in there. Not saying not to buy that one, but be very cautious with those types of homes that have those issues, because those could be very costly to fix.
Right. Mm-hmm. Now, very important, those are some practical tips. There's the financial considerations, and I think we're going to go into this, and we even have another video on affordability, calculator that we help people choose. Understand you might get mixed messages here. So, oh, you can afford this much. Okay. Afford is a relative term. Okay, because afford means, can you afford the monthly payment? Maybe, but at what cost or what expense? Okay, we saw this a lot in 2008, where people, oh, you qualify for a $500,000 home, and meanwhile they're making minimum wage. You know?
Yeah.
So understand there's different parameters and motivations, if you will, for saying you can afford X amount. Realtors, mortgage brokers, there's really good ones out there. Okay, but the structure of their compensation is a percentage of what they sell you. So the higher the price and the higher your mortgage, the more they make. Okay, so I'm not saying that's necessarily all realtors go by that, but it's a different perspective on saying what you can afford.
That's right. Yeah.
So let's talk a little bit about affordability, Jason.
Yeah. So a couple kind of guidelines of how much house you can afford. Okay, because we're I did this the wrong way personally, and we want to help people get into the right house for them that's going to allow them to not be house poor, and allow them to continue to build wealth over time.
Right.
And not to pay a ton of interest over time.
Right.
So when determining a price range, okay, remember that kind of a key thing here is you want to put down at least 10%. Okay. However, we would prefer if you did 20%.
Right.
And the reason for that is there's something called personal mortgage insurance.
Property mortgage insurance.
Property mortgage insurance, yep. So, and we'll get a little bit more into this on the other side, but the mortgage insurance, if you don't put some additional money down, that can make that more expensive.
Right.
And we're going to talk about that on another slide. But the other thing is you want to focus on a 15-year mortgage and a 15-year fixed rate mortgage.
Fixed.
Okay. So stay away from what they call ARMs, or adjustable rate mortgages, or interest only mortgages, those types of things. And while most people will try to direct you into a 30-year mortgage, and they're going to give you all types of convincing arguments of why you should do that to keep your payment low, you never know what's going to happen. But if you stick to this guideline of a 15-year mortgage, you're going to be able to build wealth quicker over time. Yes, we understand you may not be able to get more house early on, but that can be a good thing because it can avoid you from becoming house poor.
That's right.
Okay, and then as you do this properly over time, you will be able to sell that home, maybe if it's your first home, or and have equity in it. And then when you go to buy your second home, then you can start stepping it up and getting a nicer home.
Right.
All right. So you want to keep your monthly house payment, which would include your principal, interest, taxes, insurance, and PMI, to 30% or less of your monthly take-home income.
Right.
Okay. And we have a calculator, a mortgage affordability calculator, calculator that kind of helps guide you along in this area. And then we also have a mortgage comparison calculator. I would check both of those out. One shows you how much house you can afford. The other one is kind of comparing a 15-year to a 30-year mortgage.
Correct.
And obviously the reason why we guide people to the 15-year mortgage is that it saves you so much on interest.
Right.
I mean, it can save you, sometimes hundreds of thousands of dollars in interest, especially over a lifetime. And you can build equity quicker, which means if you turn around and sell your home, after a few years, you can actually not be underwater, and you can get some money back.
Right.
And a lot of times, if you go with a 15-year versus a 30-year mortgage, and you can't put down that 20%, then the PMI is less.
Right.
So. Okay, so just really quick here, as we're looking at comparing a 15-year to 30-year mortgage, just to and we actually have a calculator video that we can show you, or that you can see, that you can really play around with these numbers, but just to hit home the point of why a 15-year makes more sense than a 30-year mortgage. Just giving you this example, this is a $270,000 mortgage, comparing a 15-year mortgage to a 30-year mortgage. The 15 years at 3%, the 30-year mortgage is at 3.5%. And you can see, even though your payment is a little bit higher, $1,865 versus $1,200, the interest savings is $100,000 over the life of the loan.
That's right.
On a $270,000 mortgage, you're going to pay $436,000 in payments on a 30-year mortgage, which is a lot of money over time. So, while the monthly payment is going to be higher, it's not significantly higher than the 30-year. But the main thing is you save a ton on interest. Your goal is not to have the lowest payment.
Right.
That's the way it's sold to you.
Right.
Your goal is to pay the least amount of interest and to build wealth over time.
That's exactly right.
So hopping on to the next slide, just to go a little bit more in depth of what private mortgage insurance is. So when you don't put 20% down onto a mortgage, the bank forces you to have private mortgage insurance, which protects the bank. Not you, okay?
But you're paying for it.
You're paying for it, but it's to protect the bank in case you can't make the payments on the home. So typically it is more expensive with a smaller down payment and longer terms. So like if you get to a 30-year with very little down, it's going to be a more expensive PMI.
Right.
Now, I've done this the wrong way in the past, like a lot of these lessons that we teach, and I can just tell you out of experience, to get rid of that mortgage insurance, it is extremely difficult, okay? But the requirements a lot of times, if it's a conventional loan, is that you've had the mortgage for at least 2 years and the loan to value is below 80%.
Right.
Okay? That's not the case with all types of loans, but that is the case with a lot of them. Once you reach that point, then you can go back to your bank and you can request them to take that off. I can tell you though that when I had to do that, it took me like 7 or 8 phone calls, lots of letters, and lots of work to get it off. And it was a part-time job for a few weeks. Okay, so it's not easy. But you want to make sure that happens, because depending on the size of that mortgage, I mean, that can be anywhere from $150, I've seen them high as $250 a month. That's just money you're throwing away.
Right.
You're getting no benefit to that. Okay.
Right.
Now, sometimes, like in recent years, you have your house value actually starts to appreciate really quick. And maybe you reach that 80% LTV not by paying it down, but by rather the actual property value going up in value.
Right.
And in that scenario, you may need to actually pay for an appraisal.
Right.
Okay, the bank will require you to pay for an appraisal to prove to them that your loan is now 80% or LTV is below 80%.
That's right.
Okay.
Now that's going to vary per loan type.
Yep.
Some loans are strict. No, the only way we dismiss it is if you've paid down to that level, because they're afraid, houses will go up or it could go down again, and then we're on the hook. So it's very important that you understand what type of loan you have.
That's right. Now, if you want to get a little bit creative and you have really good credit, so there is another option to being able to put down 20%. Okay, and not everyone can do this, but if you have really good credit, sometimes it is a possibility. So it's called a 10-10-80 loan. Okay, so if you have enough money to put down 10%, and then you would get a first mortgage, and then then you put, or then you have a 10% second mortgage. Okay, so 10% down, a 10% second mortgage, and then the first mortgage is for the 80% amount.
Right.
And that is a way that you could potentially avoid PMI.
Right.
But if you do that, the second mortgage a lot of time is at a variable rate.
Right.
Okay, so after you get that in place, your job is to knock that second mortgage out as quickly as possible to avoid interest rates going up. And a lot of times at a higher interest rate, so you want to probably pay that one down first.
That's right. Sometimes it's second mortgage, sometimes it's a HELOC, equity line of credit. It's very typical, which is variable. So it's a way to do 80, 10, 10. So 80 first, you put down 10. And because the first mortgage is the one that determines your PMI, and it's only 80, you kind of circumvent it.
Yep.
That doesn't apply to everyone. You have to have strong credit. It depends on how lending standards are. When they were strict, they weren't even allowing that.
That's right.
Okay, so it varies, but it's an option.
That's right. Now, another thing, we're big believers in helping people be completely debt-free, right? And especially starting off with being consumer debt-free.
Right.
So what if you're trying to buy a home with no credit? Okay, so if you've had no credit cards, you have no car payments, you may not have established credit. Well, it is doable,
right,
but it takes more work. Okay, so you'll have to go through a manual underwriting process, and a lot of times the bigger banks, the well-known banks, won't do that.
Right.
But you'll get a lot of regional banks that actually will do it. If you can show to them that, hey, I make enough money to be able to buy this home. Look, I have zero debt. I have a lot of emergency reserves. I have a certain amount to be able to put down. Then it may take a little bit more work, but you can buy a home with no credit.
That's exactly right. So you'd have to be very intentional about finding an institution that does this manual underwriting that will be open to not using the traditional automated calculations to see if you qualify. So why do we spend so much time on this conversation? Because again, it's one of the biggest assets and liabilities that we all take over during our lifetime. So because it's such a big decision, we want to equip you with the tools, thoughts, and considerations to help you make the right decision and not necessarily make a lot of the mistakes that most of us make in this country. So we hope this helps, and we look forward to seeing you soon.